piece of information about Obama that we don't really know anything about. His records from high school, sealed. His records from college, sealed. What he wrote in college, sealed. What his wife wrote in college, sealed. He is the most secretive president, and the secrets about him are greater than any president in American history. Isn't that interesting? I thought this was going to be the most open administration in history. Right. Right, sure. New York, WOR. Joe, welcome to the Savage Nation.
Dr. Savage, I have a theory for your consideration regarding Obama, his administration, and Goldman Sachs. They're about as incestuous as the pharaohs of Egypt, as you well know. My theory is just this. Of course, the timing of the investigation of the SEC is quite suspect. And I believe if you look at, as you're familiar with options trading, there were options on Goldman Sachs that have gone up in thousands of percent. I believe if they knew the investigation was coming, those options skyrocketed in value. I believe they probably made the money to pay whatever fines they will be fined by knowing ahead of time. I
have in front of me a 4-page paper that is entitled, "Is the Current Goldman Sachs Investigation Intended to Protect the SEC?" Because I actually believe, having studied this, that this investigation of a rather low-level individual at Goldman Sachs is meant to protect both the SEC and Christopher Cox, incidentally. That's what I think. Isn't it interesting that Mr. Paulson himself has not been indicted at all?
Absolutely.
One company allegedly made $1 billion in packaging and selling these mortgage-backed securities. Why is it that he's not even investigated? Why is it that it's somebody else? Do you have an answer to that one?
No, sir, except that it's all in the family, just as you said. They're crooked on the left and the right.
Paulson's trading firm, Paulson & Company, was a member of the Managed Funds Association, MFA, which was a group made up of hundreds of financial firms and private investors who run hedge funds. Now, these hedge funds thrived and do thrive on such practices as selling short. Many of you don't know what that is, but that is selling a stock that you don't own in the hope that its value will go down and then buying it at a lower price, thus making a profit. It's the ultimate form of speculation without investment. And they also made their fortune in trading derivatives. Now, what happened in 2007 was shocking. The MFA, the Managed Funds Association, one of those principal members is George Soros, relentlessly lobbied the SEC, then under the chairmanship of the suspicious Christopher Cox, to remove the uptick rule. Now, what is the uptick rule? You don't have to be a big investor to know what I'm about to say to you. I'm going to say it to you briefly. The uptick rule was the only protection that capital markets have against what is known as naked short selling. Follow me for a minute. This rule limited short sales to securities whose last trade was higher than the previous one, and its primary purpose was to prevent hedge fund traders from selling short and thus causing the market price of a stock to continuously drop at a precipitous rate. What does it mean to you? This uptick rule was a good one, and it was initially adopted in 1938, by the way, and it helped the U.S. recover from the Great Depression by preventing the very kind of short-selling raids that led to the crash of 2008. But Christopher Cox, appointed by Bush, gave in to the MFA's pressure and eliminated this uptick rule on July 6, 2007. Once the uptick rule was removed, naked short selling was enabled, and the circumstances were ripe for assaults, such as the one that several individuals staged on the Goldman Sachs mortgage package that they helped design, all the time with the apparent intention to torpedo it through short selling. Now, you got to remember that the banks lost $2 billion. But when you hear that they lost $2 billion, what you don't understand is that the money didn't disappear. Some people actually made $2 billion, and they're not the ones that are being investigated by Obama. You put 2 and 2 together, and you'll come up with 15. I'll be right back.
Savage.
We're asking the question, is this scandal right now surrounding Goldman Sachs, Obama's Enron? And the answer is yes, sevenfold yes, because the amount of money given, to Obama by Goldman employees is 7 times greater than the amount of money given to Bush by the Enron employees, and yet we hear nothing connecting Obama to Goldman Sachs. Now, before we take our calls on this, I want to say something that's very, very important. We believe that the current Goldman Sachs charges are actually designed to divert attention from the SEC's own role in precipitating the 2008 financial crisis. And this is all going to come out of my new book, which will be out in September. I have a chapter on Wall Street that nobody in the media can top. And I would say that even traders on Wall Street are going to buy my book just for that chapter. They're going to find out that this old talk show host knows a little bit more than you might think about things that are going on in the financial world. But one of my statements, and I don't know if you agree with it, is the fact that John Paulson was not charged is quite suspicious to me, because if they did charge Mr. Paulson, his company allegedly made $1 billion, that might actually lead to our uncovering the true causes of the meltdown and the scope of the corruption that enabled it. But the big and most important thing you got to remember about this grandstanding right now is about Obama. Obama is attacking Goldman Sachs, even though he got $1 million from them, is because he's trying to get Congress to pass his so-called financial regulation legislation. What he may do if he gets this through, if he can get the dummies in Congress to be bamboozled into passing it, would give more power over to the executive branch than they're entitled to. In other words, it's another power grab by this president of ours. And the new federal financial regulation law gives virtually unlimited discretionary authority to Obama, which would enable him, for all practical purposes, to designate any financial institution he chooses to target for whatever reason as a risk for failure, and to say, do what he would tell you to do, and we'll let you continue to exist. Further, if you let Obama get away with this, the president would not even have to go to Congress to get approval for the money to bail out any financial institution that he wished to bail out. He could simply order the bailout and order the Fed to print money to back it, even if the current $50 billion allotted in the bill does not end up in the final version. This is duplicity squared, because it sweeps the real causes of the crisis that enabled the '08 financial meltdown under the rug, while at the same time giving Obama even more authority over yet another critical segment of the American economy. I'm Michael Savage, and I approve of this editorial. 1-800-449-8255.